Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHENZHEN International Holdings Limited quarterly report. SHENZHEN International Holdings Limited is a diversified investment holding company that provides a wide range of businesses and services. At its core, the company focuses on logistics infrastructure facilities in China through its toll roads and general environmental protection business segment. This segment develops and operates toll highways, wind turbine equipment sales, kitchen waste disposal projects, and wind power stations. The logistic business segment constructs, operates, and manages logistics centers, integrated logistics hubs, and provides third-party logistics services, among others. In addition to these core businesses, the company also offers various ancillary services such as electronic information exchange, supply chain management, project investment consulting, real estate development, construction of expressways, logistics and transportation services, cargo transportation and warehousing, and wind power generation systems. Furthermore, it invests in and operates wind farms. Overall, SHENZHEN International Holdings Limited's business scope is extensive, covering multiple sectors including infrastructure, logistics, environmental protection, finance, and real estate. SHENZHEN International Holdings Limited maintains a market capitalization of $18 billion, broadly in line with the industry peer group. SHENZHEN International Holdings Limited trades at a higher price-to-earnings ratio of 8 times and a lower price-to-book ratio of 0.51 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6.19%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company can be attributed to various projects and initiatives. On the growth side, several expressway projects such as Coastal Project, Outer Ring Project, GS Expressway, GZ West Expressway, and Shuigyun Expressway, before toll collection cessation, have contributed significantly to revenue increase. Additionally, waste management projects like Project I Bioland, Project III Sheiyang Project, and Guangming Environmental Park have also shown high organic waste disposal volume and operating income. On the other hand, revenue decline can be attributed to a few projects that have experienced setbacks. Shuigyun Expressway's toll collection cessation has led to a significant decline in revenue. Similarly, low-performing projects like Lisai Environmental Project, Yangcheng Zheneng Wind Power Project, and Shanghai Guangming Photovoltaic Power Generation Project have also contributed to the decline. In conclusion, the success or failure of these projects plays a crucial role in determining the company's revenue growth or decline. A combination of high-performing expressway and waste management projects can drive revenue growth, while low-performing projects can lead to revenue decline. The net income of the company experienced a significant decline, decreasing by RMB 7,070,101.21. This change in net income is a notable shift in the company's financial performance. On the other hand, both operating and net profit margins showed an increase. Operating profit margin rose from 35.1% to 38.3%, indicating that the company was able to maintain its profitability despite the decline in net income. Similarly, the net profit margin increased from 29.2% to 31.6%. This suggests that the company's ability to generate profits from its sales improved, even if the overall net income decreased. The reasons behind these changes are not explicitly stated, but it can be inferred that the company made adjustments to its operations or pricing strategies that resulted in higher profit margins. However, the decrease in net income indicates that these efforts may have been offset by other factors, such as increased costs or reduced sales. The company is indeed generating positive operating cash flow, as evident from the financial data provided. On page 3, it is stated that the net cash flow from operating activities is RMB 1,028,213,154.73, which is a positive figure. This confirms that the company has been able to generate sufficient cash from its operations. Furthermore, a comparison of the operating cash flows for January 2026 and January 2025 shows an increase in positive operating cash flow. The net cash flow from operating activities for 2026 was RMB 1,028,213,154.73, which is higher than the RMB 980,875,169 recorded in 2025. Additionally, page 15 highlights a significant increase in cash and cash equivalents of 453,778,414.80, indicating that the company's positive operating cash flow has resulted in an accumulation of liquid assets. Overall, these figures demonstrate that the company is generating sufficient cash from its operations to support its growth and financial stability. The company's debt level and interest expenses have undergone significant changes over the past year. A review of the extracted summaries reveals that short-term borrowings have decreased, while long-term borrowings have remained relatively stable. This trend is reflected in a decrease in total current liabilities and non-current liabilities. In terms of interest expenses, there has been a notable decline from CONE 2025 to CONE 2026. Specifically, interest expense and financial expenses have both decreased significantly over this period. These changes suggest that the company has made progress in managing its debt levels and reducing its interest expenses, which could be beneficial for its financial health and bottom line. The company's dividend policy has been consistent over the past 2 years. In both CONE 2026 and CONE 2025, the company has distributed dividends to its shareholders. This indicates a commitment to returning value to investors through regular payouts. The payment of dividends in consecutive periods suggests a stable financial position and a willingness to reward shareholders for their investment. That concludes the financial summary for SHENZHEN International Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.